Welcome, Tradesmart University students, to Class 3 of Risky Business. This chapter is titled Trade Management. And I'm really excited to be teaching you, this chapter tonight because trade management is so important to the overall puzzle for each and every trader. Because trade management embodies so many fears: the fear of missing out, the fear of leaving money on the table, the fear of losing. And if you don't have a trade management plan in place that is very specific and easy to follow, it will become maddening trade management when you are trying to manage a trade, because what will happen is that you will just manage a trade based on what happened on the last trade. And so the only way to get through those fears and to get consistent is to actually have a plan. And so I'm going to be showing you 5 very specific ways that you can manage a plan, that you can test out, try, incorporate into your trade management plan, maybe make some tweaks, make it your own. But let's get to it. If you recall, we already covered risk management, which we talked about how to think like a trader, how to utilize risk units to measure your trading and to acquire the skill and consistency that you need. Class 2, we covered how to use the R measurement for directional option traders, whether you buy calls or puts. And then tonight, trade management. And then in Class 4, we're going to kind of put it all together and get to the charts and things like that. And so real quick, just going to do a quick review. Remember, the whole outcome of this class is to bridge that gap between the professional trader and the amateur trader. The professional trader is the traders, the 10, 15% of traders across the planet that consistently pull profits from the market and have that steady rising equity curve, while everybody else has that up and down roller coaster or bleeds their account out or blows their account up. And so risk and trade management mastery, those are the 2 major components of risky business. And so today we're going to be focusing on the trade management part. So specifically what we're going to cover in this class, I'm going to give you a trade management overview and then some of the psychology behind trade management. Now don't freak out about that, because remember, trading is 20% kind of knowing what to do and understanding the market and technical analysis, but the bulk of it, 80% of it, is actually being able to do what you're supposed to do when you're supposed to do it, whether you want to or not. And that is all inside the psychology for each trader. Then I'm going to give you 4 trade management strategies. And then I'm going to give you my trade management plan. And the reason I'm going to do this is because there are many students in here that are day traders like me and short-term swing traders. And so after the first class, many asked me to include my trade management plan. And so I'm going to show you mine, and maybe you can take bits and pieces of it and and make it your own. And then we're going to be talking about setting and reaching targets, because again, that is part of trade management. When do you sell? When do you take profits? And so we're going to cover that. And then we're going to lastly in this class finish with the record keeping, and then we'll just do some wrap up. Again, with proper risk management and trade management mastery, you will become a professional trader for life. And so a quick review, the 4 musts of trading. You want to identify your edge. People always ask me, you always say edge, Alfonso. How do I know what my edge is? Your edge is your strategy, your specific way that you rule out charts that you won't trade and have rules that are specific to charts that you will trade. Then you need to assess the risk to reward ratio. Remember, you don't want to be trading to risk 100 to make 100. You want to be risking 1 risk unit to make 3 plus risk units. Consistent trade management. You will see at the end of this class that there is no other way to smooth out the randomness of the market unless you have some type of consistent trade management plan. Otherwise, it'll just be maddening and you'll just be trading based on your emotions and what happened on the last trade. And then lastly, and maybe most important, monitor your stream of thoughts. Because if you don't have a rock solid psychology and the emotional maturity to follow a plan, you will just be erratic and random and wonder why you don't get consistent results. So quickly, we're going to cover those 5 steps of trading as part of the review. Remember, step 1, you first determine your R you're going to use for each trade for the sample of trades that you're going to do, whether it's 20 or for a period of time. You're going to determine your entry price, your stop price based on the chart. Calculate how many shares or contracts to purchase by taking your R unit and dividing it by the stop, or using the formula that I showed you for the options. And then you're going to identify your target on the chart and make sure that it has an acceptable risk to reward ratio. And if it does have that acceptable risk to reward ratio, then you take the trade when it triggers. Remember, how to calculate R's for options, that we're expecting the underlying security to move and improve the value of our options. And the best way to determine this is using the Greek delta. And so remember, every time the delta moves 0.50, that means a 0.50 delta means that for every 50-cent move in a stock, you'll have a dollar movement in your stock option. And so we're going to take a short break, then we're going to come back into segment 2, and we're going to specifically talk about mastering trade management. I'll see you soon.